Good morning and welcome to this webinar, Tax Tips for Realtors. Thank you for joining us for this Tax Tips for Realtors webinar with Linda Marlor. This webinar is part of the Maryland Realtors Webinar Thursday series and one of the free Maryland Realtor benefits. The webinar topics are wide variety to help you work smarter, not harder, presented to you by speakers from across the country and in your own backyard. This webinar is being recorded and will be available on the Maryland Realtors website. Known by many as the Tax Lady, Linda is often described as one of the most engaging, fun, and informative teachers and lecturers in the Greater D.C. Metropolitan Region. She is Metropolitan Region. She is respected all over the region for her intricate tax knowledge and fun-filled approach to taxes. In today's webinar, she will also be covering the new tax law. Linda will answer questions at the end of the presentation. Linda?
Hello, good morning, everybody. The first thing I wanted to tell everyone who's listening in is to say a big thank you, and I mean big thank you, to the Maryland Association of Realtors. Because of them and the real estate lobby, many of the new tax laws are not as bad as they could have been, and some are better than they would have been because of the lobbying. In other words, you know, there's lots of changes to it I'm going to talk to about today, but some of them are really, really important for realtors and people who are owning homes. But because of the lobby of the real estate lobby did the work that they did, some of these laws are not as bad as they could have been. And some, like I say, are even better. The first thing we're going to talk about is your tax rate. Does everybody know their tax rate? No, of course not. That's the big thing that everybody needs to know, whether you're a realtor or whether you're the person who's buying the house or selling the house. First thing I also wanted to tell you was, please, you know you're not supposed to give tax advice. And this year, because of the tax law change, a lot of your clients, whether they're sellers or buyers, are going to be asking you how it affects them. One of the things I wanted to get out of the way, because I was giving a speech yesterday for a group of investors, and they were worried about the law that said that you had to keep the house a certain amount of time before you could sell it if it was your personal residence. And I just wanted to let you know that that law has not changed. You know, it's still 2 out of 5 years. Or you can just own the house for 2 years before you sell it, and you're still entitled to take a $250,000. No, they were going to change it to 5 out of 8. Yes, the people here in the room, they're already excited about this. They were going to change it to 5 out of 8 years, but they did not. So the remaining law is still the law that we had prior to the change, which is 2 out of 5 years. So if you own a house for 2 years, you can sell it. You can exclude $250,000 if you're single and $500,000 if you are a married couple. So don't worry about that one. It didn't get changed. But getting back to the words of wisdom here, please, you know you're never supposed to give tax or business advice to your clients. First of all, if you ever have a tax question, I have 20 wonderful, genius people in my office. By the way, they're all smarter than I am. So if you call the office, don't ask for Linda. Everybody there who answers the phone is smarter than I am. We will answer your questions for free, obviously. You can send us an email or give us a call, and we will take care of you. But don't be giving advice to your clients no matter what happens. Now, the next thing I wanted to tell you was, even now with the new law being more complicated, you definitely don't want to do your own taxes. Please get someone to help you who knows how to do taxes for realtors. You folks are self-employed. Your real boss is yourself. I know you work with your broker, and your brokers are also bosses, but you are your own boss, and you have a lot of complications on your tax return that you're responsible for. The tax code, well, it was 74,000 pages. I guess it's a few thousand pages longer now because of the new law. And this is really the biggest change we've ever had since 1987. So there's a lot of things in it that are going to help and also to hurt a few people. But in any case, your time is way too valuable. And I always use the analogy of, you know, you don't cut your own hair. Why? You can't cut your own hair. You're too close to the subject. So you shouldn't be doing your own taxes. I don't even do my own taxes. I'm lucky enough to have my son, Preston, who runs the company now, and he has to do my taxes, poor fellow. But in any case, try to get some professional help. Don't do it on your own, especially now because of this new tax law that says if you are a pass-through entity, which means you're self-employed basically, or you have a LLC, or you have a subchapter S corporation, there's a special 20% deduction. But we're going to talk about that in a minute. Okay, the next one, read this one to yourself. Everybody who's looking at the screen, what does it say? Come on, I want to hear you. Scream it out. Yes, the hardest thing in the world to understand is the income tax. That was Albert Einstein, okay? Now, I'm not saying I'm smarter than he is, but I have spent my whole life worrying about income taxes. So again, if you need help with your taxes, make sure you get it from someone who's experienced with helping realtors. And if you go to a regular tax accounting company, find someone who's been doing taxes for realtors for at least 10 years. Because if they haven't had 10 years experience, they absolutely will not be good enough to figure out all your wonderful deductions, and you're entitled to lots of them. Okay, now let's talk about the tax rate. For 2017, they did not change. In other words, these are the laws that are in effect for 2017. So let's just take a peek at it. If you have at least $37,000 of taxable income if you're single, or $75,000 of taxable income if you're married, you get to pay 25% tax on your rate, okay? Now, that's in effect for 2017. The new law is lower. Yes, something good happened. Okay, so now, if you make the same amount of income, instead of being in the 25% bracket, you're going to drop to the 22%. So that's good. That's a 3% drop. And then those of you who've been licensed a long time, you're veterans, you're making lots of money, you can see your tax rate is also dropped to 3, something like that. It depends on your income. Now, that's just your federal tax bracket. Let's think about this. How many tax returns did you file last year? Usually everybody says just one, but that's not true. You actually filed 2 returns at least, because you have a state return and a federal return. So you need to know your state tax bracket also. Now, we live in Maryland. We have a kind of a high tax. It's worth it though, because we love living in Maryland. And that includes our piggyback tax for the county. It's 8.95%. But that's only if you make over a couple of $100,000. But I'll tell you the bad news. If you have at least $3,000 or $4,000 of taxable income in the state of Maryland, and that's not much, is it? You automatically fall into at least the 8% bracket. So it's going to be 8% added on top of your federal bracket to compute your total bracket. Now, as you can see, DC is a little bit lower, and of course, Virginia is much lower at 5.75. But don't everybody move to Virginia. Let me tell you why. Virginia is very nice. The real estate taxes are a pretty good rate, but of course, on every car that you own, or boat, or airplane, you have to pay what's called a personal property tax. So that sort of eliminates some of the tax savings in Virginia. But Virginia is a wonderful state, and I have lots of clients who live there, and I don't mean to say anything bad about Virginia. They're very lucky because their tax rate is lower. Now, let's get to the tax that's really important for realtors. This law did not change at all. This is the same as it was in previous years. Now, when you're employed, you get a paycheck, and your employer pays half of your Social Security tax, and you pay the other half. So that's easy. But now, who's your boss? You are. So who's going to pay the other half? You are. So if you add the two of them together, what's the total? Yes, it's 15.3%. I like to use as an example let's say someone they made $60,000 gross this year doing real estate. And let's say that their business expenses were $20,000. So that means their net income from real estate is how much? Come on, 60 less 20 is 40. Now on that 40,000, they're then entitled to take personal deductions. It could be they gave a lot of money to charity, or maybe they own a little rental property. It's quite possible that we could get their taxable income down to 0. So you absolutely would think that that would get them out of paying all their tax. Well, unfortunately, that's not true, because on that 40,000, no matter what they do with it, even if they give it all to charity, even if they have a $40,000 deduction for rental properties or whatever, they're still going to owe the 15.3% tax on their net income of $40,000. Now let's use your mind here a little bit. What's 15% times 40,000? Can you do it? It's $6,000. So no matter what happens, even if they end up owing no federal tax, no state tax, they're still going to have to pay $6,000 to the Social Security Administration. This is why it's really, really important for realtors, or actually anybody who's self-employed, to get professional tax help. Now let's add up all your tax bracket, and let's talk about last year. So for last year, if you had only $38,000 taxable if you're single, or $77,000 if you're married, then you're going to pay tax at 75%, plus 15%, plus 8%. That's a grand total of 48%. That's a lot. And those of you who've been licensed a long time, you're veterans making good money, your tax bracket could be as high as 62%. You see what I mean? But here's the good news. Under the new law for this year, and by the way, the new law starts January 1st of this year, your tax rate would probably drop to 22 or even 24%. Plus the Social Security, that didn't change. Maryland didn't change. And now we're down to a total tax rate of 47%. So that's a little bit better, right? We like that. And we'll take anything we can get. Now, let's talk about some of the general changes that are really, really important. The first one is kind of bad for the real estate business, because what they've done is they've doubled the standard deduction. Now, let me explain to you. The standard deduction is a deduction that everybody's entitled to. You don't have to own a home. You don't have to be anything. You just have to have lived during the year, and you're automatically entitled to the standard deduction. They've doubled them. In the past, the standard deduction for a single person was 6, so now it's moved up to 12. For a married couple, it was 12, and now it's moved up to 24. Now, the reason why it's bad for the real estate people is because this makes the joy of owning a home at least only a joy, but not a tax savings. Many people used to think about buying their first home because they really wanted to save on their taxes. And that's a good reason. There's nothing wrong with wanting to save on your taxes. I think everybody should own a home. I'm sure you agree with me as realtors. By the way, I'm a realtor also, although I haven't done any real estate in the last 30 years. I do have a real estate broker's license, but that's because I teach for the continuing education for D.C., Maryland, and Virginia real estate commissions. But in any case, this standard deduction might present a problem for people who were on the fence thinking about should they buy a home or should they not buy a home. Now, if you have a single person who's going to get an automatic deduction now of $12,000, the benefit from buying a first home or any home is much smaller than it would have been under the old law. So let's not tell them the law changed. First of all, it's not your job to tell them anything anyway. So let's keep this one a secret. Now, of course, if you're a married couple, you're automatically going to get a $24,000 deduction, whether you own a home or not. So the same thing goes there, whether they buy their first home or keep owning homes. Don't tell them. It's not your business to tell them, and I'm not going to tell them. So if I don't tell them and you don't tell them, the only way they're going to find out is if they read all of the tax laws, and let's hope they don't, because as you know, everyone's better off owning a home. Okay, the second one, okay, those of you who have children, guess what? You don't get any exemption any longer for having children. You know, many of our clients have 2, 3 children, and we used to put their names on the tax return and their social security numbers, and then they used to get a nice big deduction, $4,000 approximately for each child. Those are no longer allowed. There are no more exemptions allowed for children or for anybody on the tax return. So if you're married, you used to get 2 exemptions, one for you and your spouse. That's no longer allowed. I have clients who support their parents or other relatives other than children. There's no exemption. Those are gone, okay? That what they did was they raised the standard deduction and took away the exemption. But it doesn't quite equal out, because if you have a child or 2, this losing of the exemption hurts you more. Now, I'm not going to get into the political aspects of whether the new law should have been passed or not, because we have to deal with it. It's already here, and there's nothing we can change. But unfortunately, those of you with children who are used to getting big deductions, you're not going to get them. There is a little change in the tax credit that's allowed, but your child has to be under the age of 17. It did double. It was $1,000. Now it's up to $2,000. But the child has to be under a certain age, so that doesn't help you if you've got kids in college. And there's also an income limit that can help you to lose that credit. So the exemptions were allowed in a different way. But the income limit was raised for the amount that you can claim for the credit. But we're not going to go into that right now because I want to talk about things that help realtors. So with standard deduction is doubled, the exemptions are gone. Now, let's talk about SALT, S-A-L-T. What in the heck is a SALT? Well, SALT stands for your state and local taxes. Now, the new limitation on this, which we've never had before actually, is $10,000. That's the most amount that you are allowed to deduct for your state and local income taxes. This would include people who live in states that don't even have a state income tax because they sometimes claim sales taxes. But let's just talk about Maryland. In Maryland, we have that nice 8.95% tax, which normally everybody would get to deduct. Plus, they would also get to deduct all of the real estate taxes on their primary residence. And if you're lucky enough to own a secondary residence, you can take that one also. Sometimes people have a cabin in the woods, or they might have a beach house, or maybe they have both. In any case, you were allowed to deduct all of the real estate taxes on all of your homes. Now, when I'm talking about homes, I'm talking about places where you actually sleep. I'm not talking about rental properties, because the laws for rental properties didn't change at all. Those are still the same. But what happened is the limitation of $10,000 means that, let's say you have someone who pays $7,000 in real estate taxes for their home and or second home. And let's say they have $4,000 they pay each year to the state of Maryland on their income tax. Well, 7 and 4 is 11. So they'll only be able to deduct how much? Come on, you can do it. Yes, they'll only get to deduct $10,000. And by the way, if you have a client who owns real estate in foreign countries, it used to be that you could deduct the real estate taxes paid to foreign countries. Well, that's no longer allowable either. So basically, your state and local income tax, the most you can deduct is what you pay on your house, what you pay to the state of Maryland, what you pay on any second home or third home, up to $10,000 limit. And that covers probably most of the people that we deal with in our office. But it will hurt people who are in high incomes or who own several homes. This reason for this change here is even more incentive for self-employed realtors to claim an office in home expense, because realtors, and most all of you that I do, and we do over 2,000 realtors taxes, we always try to claim office and home expense, because if you have a space in your home that you use regularly and exclusively, you're entitled to claim a portion of your home for business purposes. That's the new law that was passed in 1999. It's still, I call it the new law. Now, let's say that you use your house, 10% of it for business. Usually it's about 6, but we'll just say 10. If you want to, what you can do is claim 10% of your real estate taxes as a business expense on the business portion of your tax return. And that means the other 90% of your real estate taxes on your home are claimed as a personal deduction. And that would allow you to claim more taxes that you pay to the state of Maryland. So those of you who have up more than $10,000 in state and local taxes plus their homes, you really, really should be claiming an office and home expense. Now, office and home is a little complicated. You have to fill out a Form 8829. That form has 43 lines and 3 columns. Most accountants who don't deal with realtors have no idea how to even fill it out. It's complicated, but if you do your taxes with someone who knows what they're doing, they can take that extra deduction for you, which will allow you to claim more than the 10%. You know, I'm always looking for a loophole. So that's the loophole on the state and local income taxes. Now let's get to the mortgage interest deduction. Oh my goodness. Well, again, thank you to Maryland Association of Realtors and the real estate lobby, because this one they had wanted to reduce to 500,000, but that didn't happen. So any mortgages that start this year, after this January 1st, they are limited to an amount of $750,000. That's the most that you're allowed to claim. Now that has to be money that's used for one of three purposes. It must be used to buy, build, or improve your primary residence or your secondary residence. And you're only allowed to choose one secondary residence. So if you have a property at the beach and a property in a cabin in the woods or something, obviously you'd want to choose the most expensive one. So the mortgage interest deduction is limited to $750. But I have good news for those of you who have a mortgage of more than $750 that was put into place before December 15th of last year. Those were grandfathered in. That means that anyone who has $1 million mortgage can still claim all of that interest, even though it exceeds the amount that's allowed for this year. So the new mortgages are limited to a total of $750, and you're only allowed to use the money for what? Do you remember those three things I told you? Buy, build, or improve your primary residence or your secondary residence. Now let's get down to the sad one. Refinancing and HELOCs are no longer deductible, no matter when you took them out. So let's say that you took out a HELOC, a home equity line of credit on your home last year sometime or a couple years ago, and you used the money to pay your child's college tuition or to buy a car, maybe to pay off some credit cards. That's the normal thing. Those are no longer deductible, period, gone. Nothing. Doesn't matter whether they were taken out last year, the year before, whatever. They're not grandfathered in. They're no longer deductible. And if you do a refinance this year for a loan, then you're only allowed to refinance for the exact amount of the balance on your loan. And that's it. So if you do a refinance and take out 50,000 more or something, unless you use the money to buy, build, or improve your primary residence or secondary residence, then that interest will not be deductible. So please keep that in mind. This is another reason why I want you folks to have what's called a solo 401k, because if you have a solo 401k, you can borrow the money out and use it for other things, and that way we're not worrying about being able to deduct the interest or not. But I'm going to come to that at the very end. Moving expenses are no longer deductible, and I think that's really important for us here in Maryland, especially realtors, because we get a lot of people moving into Maryland. Sometimes they're just moving from D.C. or moving from Virginia, but the expense of actual moving, as long as you move over 50 miles, which used to be deductible, is no longer allowed. That one's gone. So moving expenses after January of this year, no longer deductible. Here's the child tax credit. It was raised from $1,000 to $2,000. Now that only applies to children under the age of 17, who are your dependents, of course, and there are some limitations on the income. Luckily, they did raise those limitations, though. Now, the change in medical deductions I'm going to cover in a minute, but I just want to let you know that during 2018, and actually it should be 2017, it was 7.5%, and starting next year, it's going to be 10%. The requirement, the mandate for having health insurance is now not going to be enforced anymore. There is no mandate for the ACA, that's the CARE Act. It's not required. As of 2019, you're not required to have insurance. The estate tax, you'll be very happy to know about the estate tax. The estate tax is doubled the amount that's exempt from it, I should say. This will help your wealthy clients, and hopefully it'll help you. So this means that if you have $11,000 worth of net worth when you pass away to your little cloud, then you will pass away tax-free. And a married couple is allowed to have over $22,000. So that really helps the wealthy folks. I'm not so sure if they needed the help, but they're going to get it under the new tax law. Let's talk about businesses, and this one I'm going to cover a little more in depth in a minute. The sole proprietor, that's what you are. Normally a realtor, when they become self-employed, they're just considered as a sole proprietor. That's the normal thing. You're considered also to be a pass-through entity. Don't worry about that. It means that you pay taxes on whatever is left after you deduct all your expenses. Well, that is going to be a special 20% deduction. We'll cover it in a minute. Entertainment for certain kinds of things is no longer deductible. They haven't quite figured out how this is going to work. But the first thing that's gone, really gone, are tickets to sporting events. Oh my goodness, did anybody buy tickets to the Super Bowl? Well, if you did, you probably bought them last year, and if they're going to be deductible since you paid for them last year, you'll get the tax deduction. But if you buy them this year, any kind of sporting events, or if you take your client to the Kennedy Center, or if you just take your client to the movies or something like that, those tickets are not deductible. That's the part of it that they're disallowed. Now let's talk about pass-through businesses. The current law says that if you have income from a partnership or an S corporation or a sole proprietor, which is probably 90% of you out there, they're going to be taxed at the individual rates. So whatever your tax rate was, that's what you paid the tax on. The new law says that this same amount of income, you're going to get a lower rate of up to 20% on the first $315,000. Now, this one gets a little bit more complicated than that, so I don't want to spend too much time on it, but let me just give you a breakthrough here. If your income, if you're single, is $157,500, or if you're married is under $315,000, and I'm talking about your taxable income, you will get a special deduction of up to 20% of your net income. So let's say, remember we talked about the person who had $60,000 income, and how much were their expenses? Do you remember? They were $20,000. They were business expenses. So their net income from real estate was how much? 60 less 20 is what? 40. Now, what's 20% of 40? You can do it. Come on. It's $8,000. So under the new law, that person would be entitled to deduct up to $8,000 as long as all of their taxable income, because maybe they're married and maybe they have other income, as long as their income was under $157,000. If they're single, $157,500, excuse me, or $315,000 if they're married. This is going to be very complicated. There's special forms that have to be filled out in order to be able to claim this 20% deduction. So what I want you to realize is that if you have someone doing your taxes who's not familiar with realtors and not completely familiar with the new tax law, if they omit that deduction, you would be losing the ability to deduct 1/5 of your income. Oh, that would be a terrible thing. Okay, now let's talk about entities. Sole proprietor is normally what happens to a realtor. They become a realtor, they become an agent, their broker pays them money, and they receive it on a 1099, and then when they file their tax return, they just include that money, take their deductions, and it's on a Schedule C. And the Schedule C, the title of that schedule is called sole proprietor. Now you also have a choice. You can become a single member LLC. Now, LLC stands for Limited Liability Company. It has nothing to do with being a corporation, but it has everything to do with protecting your assets. I particularly love LLCs because I say it's like building a brick wall around your assets. You can also choose to be a C corporation or an S corporation or a multi-member LLC. Now, this is where you always consult the attorney in order to form the corporation. But I should have saying here that you also need to speak to your accountant, because your accountant will choose which entity is best for you. Now, most realtors are a sole proprietor. They file the Schedule C, they pay income tax, Social Security, and state tax, and they have no liability protection other than their errors and omission insurance. Whereas, oh, see the little hearts? Oh my goodness, this is my choice. I would prefer that they become a single member LLC. Now, the state of Maryland has allowed them since 2005. So they're allowable here in Maryland, also in DC and Virginia for those of you who are licensed there. You still file the same Schedule C and you still pay all the same taxes. So by becoming an LLC, it doesn't save you anything tax-wise, but it does limit your liability. So your liability is limited because of this brick wall. And in Maryland, you pay a $300 fee. In DC and Virginia, it's $100 or maybe a little less. But Maryland does charge $300. Now, when you put the money into your LLC checking account, you're allowed to take it out at any time. So your broker pays you money, you put it into your LLC, you need the money the next day to pay your mortgage or to pay anything that's personal or business, you can just take it out, no problem. Okay, you can elect retroactively to be treated as a C corporation or an S corporation or as a partnership once you file the LLC. Now, let's talk about the medical expense. Remember I told you that the medical expenses starting next year, you're going to have 10% of your income in order to deduct anything. So that's not good, is it? No, of course not. In order to claim medical, that means that you have to be either very, very sick or very, very poor. I prefer that all of you be extremely rich, first of all, extremely healthy and extremely rich. And as an example would be, let's say we have a married couple and they each earn $50,000. So at the end of the year, they file a joint tax return. What happens? They've got $100,000 income. What's 10% of $100,000? Well, 10% is $10,000. So if that married couple has $9,000 worth of medical bills, how much can they deduct? Nothing, because the $9,000 doesn't exceed the $10,000 floor. Or let's say they have $11,000 worth of medical. How much can they deduct? Only $1,000, because the $11,000, you take the $10,000 of their income and subtract it. So they can only take the amount that exceeds it. So that's not so good either. Now, back in 1955, Congress did a really good thing. And I was giving a speech yesterday to some people who are involved with Congress. I won't say who. And I asked them, I said, how often does Congress do a really good thing? And they said, not very often. But in 1955, they really did, because they have this law that was passed to help farmers, because they thought it was a very good idea to consider a husband and wife as a farming team, as if they're a little company. Because what happens on the farm? Well, the wife would milk the cows and the husband would till the soil, and they were considered like a little company. So Congress said, let's let them deduct all their medical bills off the top of their income as a business expense. So they passed this law, and I was studying one day in a tax class at, this was a long time ago, at American University, and the professor was teaching this law, and I thought about it, and I woke up at 2 o'clock in the morning, and I said, whoa, wait a minute. This works for farmers, but I have realtors that I know who are clients who also work together, the husbands and wives, as a team. Usually it's the woman who's the realtor, and her husband helps her a few hours a week, maybe 8 hours a week, pounding signs or doing things for her, stuffing envelopes or whatever. So I went the next morning and I beat on the professor's door and I said, wait a minute, can't we use this law to help anybody who's self-employed that's a team? And he said, yes, of course you can. So I've been doing these plans for over 30 years. And all that's required is that you hire your spouse or your significant other, but it works better if it's your spouse. Now, those of you who are single, sit tight. I'll get back to you on this one. But you have to pay them a tiny salary. I know they're worth lots of money, but you have to give them, let's say, $300 a month salary. Now, what happens then? Well, your income goes down $300 a month. So that's good. But then you're going to file a joint return. So what happens? Their income goes up $300 a month. So that's actually a wash. When you file the joint tax return, nothing changes. But here's what really happens. You are now allowed to reimburse your employee for what? For all of their family's medical expenses. So let's say that we have Christine, who's the lawyer, and her husband is Fred. So Christine is the lawyer, realtor, whatever kind of self-employed person. She hires Fred, and she gives him the little salary, even though he has a regular job, or he could be retired, doesn't matter. And every once in a while, Fred will go up to Christine and he'll say, "Hey, boss, you know, my wife was very expensive this month. She spent $400 on glasses, and I went to the dentist and it was $400, and the children had a couple $100 worth of co-pays or prescriptions. I need to get reimbursed." So what happens is Christine, out of her business account, and this could be her Schedule C account, it could be her LLC account, or it could be her corporate account, she writes him a check for the $1,000 medical bills, and she's allowed to reimburse him throughout the year for everything. I'm talking about health insurance, dental, cancer, long-term care, all out of pockets, anything that's deductible as far as co-pays, prescriptions, dental, vision. If the doctor prescribes anything for you, this would include things that the doctor prescribes, such as vitamins, condoms. Everybody usually laughs when I say condoms. Sunscreen, diaper rash ointment, anything prescribed by a doctor now becomes a business expense. So at the end of the year on the tax return, the realtor, which we'll say is Christine, she would deduct on her Schedule C or her corporation any of the medical expenses, and they're considered to be an employee benefit. There's even a special line to put it on. Now, what has this done? This means that we have taken, it's called alchemy. You know what alchemy is? Where you take lead and you turn it into gold. What I have just done is taken all of your non-deductible medical bills and turned them into fully deductible business expenses. So on one part of the return, they're not even allowed, they don't save you anything. You put them on the business part of your return, they save you federal tax, state tax, Social Security tax, and Medicare taxes. So you've gone from saving zero tax to saving 4 different kinds of taxes. This is the best kept secret in the whole tax code. It's the most overlooked deduction also. We set up more of these plans than anybody in the United States, and I think it's because, well, obviously because we do more realtors. Because if you're not a farmer and you're a realtor, this is the one that really works. Now, those of you who are single, you say, well, I don't have a spouse that I can hire and reimburse. Well, then it's really simple. Let's say that Christine is single. Then she forms her C corporation with her lawyer. And now on her C corporation, she says, well, you know, I'm the president of my corporation. I think I should have some benefits, you know, deduct my car, deduct something, space in my house. Oh, by the way, I think I should deduct my medical bills. So she signs her little contract with herself. And of course, we have to prepare that for her. And that way, now she can write, if she wants to, all of her medical bills out of her corporation, which means that every medical bill she has comes right off the top. How do you like that one? I love it. This is the most overlooked tax deduction in the whole tax code. Now, let's go on to my favorite thing to talk about. And under the new law, this is especially important. You know, I just read an article in the Washington Post last week, and it said that by the year 2030, now don't cringe, because that's only 12 years away. By the year 2030, half of what everybody receives for their Social Security check will go to pay towards their medical bills. So that means that by 2030, let's say we have somebody who's getting $2,000 a month from Social Security. 1,000 of it for sure is going to go towards paying their medical bills. That's obscene. So this is another reason why we need to put money away for our retirement. We live in the most wonderful, powerful country in the whole world. Yes, we do. Don't anybody argue with me on that one. But in this wonderful, powerful country in which we live, there's a very sad fact. And the sad fact is that 95% of all presently retired Americans are dependent on one of 4 sources in which to survive on a month-to-month basis. They cannot get along month to month without a check from Social Security or their church, relatives, whatever, children, welfare. Unbelievable. Okay, now you don't want to be one of them, do you? No, I want you to be one of the 5%. Well, here's what you're going to do. It only costs $50 a year. Don't tell me you can't afford to open up your own retirement account for 50 bucks a year. You know something? I just thought of that. By the way, that $50 a year you pay for your solo 401k, that's deductible. So you're going to get back almost half of it. So it's only $25 a year. How's that? Now, solo 401k was invented by Congress, another good thing they did, in the year 2001. In the year 2001, Congress said, oh my gosh, we made a terrible mistake. We forgot to give self-employed people the ability to have their own qualified, this is an important word, their own qualified retirement account. So they invented the solo 401k because it is a qualified account. And I'm going to tell you the difference between qualified and unqualified in a minute. But let me tell you, anything that you put into it, of course, is tax deductible. That's off the top. How much can you put in each year? If you want to put in a lot, you're allowed to put in 20% of your net earned income plus $18,500. Now, if you're over age 50 during the year, you're allowed to put in an extra $6,000. The most you're allowed to put in this year would be 55 plus the 6, which is 61. So let's say that we'll talk about Christine again. Let's say Christine had a pretty good year in real estate and she made $150,000. And she comes to Taxmasters and we do a good job on her return and we find, let's say, we find about $50,000 worth of business deductions. So she made 150 less 50. That means her net income is $100,000. Now, Christine does not want to pay taxes on $100,000. So she says, oh, hey, folks, Taxmasters, make it disappear. So we tell her, well, you're always allowed to put away $18,500. She said, yes, I'll do that. I'll put that away. It'll save her money because it comes off the top of her income. And she says, can I put away more? I say, yes, you certainly can. You're allowed to put away 20% of your net income. Well, 20% of $100,000 is what? 20,000. So 20,000 plus 18,500 is what? 38,500. Now, if Christine is over age 50, she's allowed to put in the extra 6. So that makes it even better. But let's talk about the person who made the $40,000 net and they want to put money away. How much can they put away? Well, they made $40,000, so for sure they could put away the $18,500. And they want to put away more? Well, what's 20% of 40,000? That's 8,000. So 8 plus 18,500, that's 26,500. Now, if that person is over age 50, they could also put away another 6. So what's that? Come on, can you do it in your head? What's the total? It's about $32,500. So out of $40,000 income, if you don't need it right now, because you can take it out the next day as a loan, but in any case, you're allowed to deduct up to $32,500. Now, do any of you out there have one of these outdated, unqualified accounts? If you have a SEP, Simple, Keogh, IRA, those are unqualified accounts. 17 years ago, Congress passed a law so that you would never have an unqualified account. Now, would you like to know the difference between a qualified solo 1K and an unqualified SEP, Simple IRA, or whatever? Here's the difference. Read this with me. A qualified account is federally protected 100% from creditors, lawsuits, and bankruptcy because it's a qualified account. A qualified account allows the largest contribution limits. It's $61,000 this year. A qualified account, and this is really good, allows you to borrow from it. You can borrow the money out for any reason whatsoever. You can borrow it out for 5 to 15 years. Now, if you're taking the money out just to buy a Harley Davidson motorcycle or to go shopping or pay off credit cards, then you have to pay it back within 5 years. Or if you're taking the money out to buy an investment property, you pay it back in 5 years. If you're taking the money out to buy your home, your principal residence, you need to pay it back in 15 years, even better. Now, when you borrow the money, what happens? No penalty, no tax, no age limitation. You can be over 71 and a half and you still can take the money out with no penalty, no tax. You can contribute to it. I have a client, she's 84 years old. She's been my client for 30 years. And every year she puts over $50,000 into her what? What do you think? Into her solo 401k. It's a huge deduction for her, and she's allowed to do so because it's a qualified account, and even though she's over 71 and a half, she's still allowed to do it. Now, the good thing also about a solo 401k is that if you want to contribute to it, you have up until October 15th of the following year. So what does that mean? That, well, if you have an IRA, the money has to go in by April 15th, so that doesn't give you much time. But now you have until October 15th to save up the money. I was just talking to a client yesterday who's saving up for a wedding, and she wants to use her money right now for the wedding for her daughter, and she's going to have some extra money coming in this summer for some settlements, so she'll use that to put the money into her solo 401k before October 15th. Now, let's think about this. How can we use this law to help you not only save for your own retirement, but to make more money in commissions? And I am all about helping my realtors make money in real estate commissions. I remember being a single mom and supporting my little girl, who now does real estate, by the way. I was supporting her and living from commission to commission. Okay, let's think about it. How many of you have clients who are self-employed? Think about it. Lots of you do. I'm proud of probably all of you. 30% of everybody around here is self-employed. So what happens is you have a self-employed client. They might need some money to buy a property from you, whether it's their home or second home or an investment property. So here's what would happen otherwise. You've told your client that they need a certain amount of money to bring to the settlement, and they go through their finances and they find out that they're about $10,000 short, or it could be $50,000 short. We can use any number, but we're going to use 10. So your poor client doesn't know about this rule, so they walk into their I won't say stupid, they walk into the place where they have their SEP or IRA, because they have a bad tax accountant who never told them that they were eligible for a 401k, or they have a bad investment advisor who never told them they were eligible. So they withdraw the $10,000 from their SEP or IRA plan. Now, what happens immediately when you take money out of a SEP or an IRA? Of course, it's taxable. So let's say your client is in the 25% tax bracket. They're immediately going to owe $2,500 tax. It could quite possibly be that your client is in the 30% bracket. So now what's 30% of 10,000? Yes, they're going to owe $3,000. They're also living in Maryland, so they have to pay 8% tax on the 10,000. How much is that? 8% of 10,000 is 800. So on top of the federal, they pay the state. Oh, guess what? Your client is under 59 and a half. What does that mean? That means they have to pay a 10% penalty on top. Now what happens? Well, if you add at least 25% federal tax, $800 state tax, $1,000 penalty, that's $4,300 tax right now, today, that must be paid. No, they wanted to have the $10,000 from their SEP or their IRA. They've only got $5,700 or less that's left over. You're going to lose the sale. They're going to lose the house. This is not good. What this person needs to do, they need to talk to a proper tax accountant who knows what they're doing. We would, if they were our client or they called us, we would refer them to somebody that we use. Now, I don't sell 401k plans. I don't get any commission on selling them. I get nothing out of it. I just sleep better at night if I know that everybody who's self-employed has a solo 401k. So now your client has rolled their money over. There's usually no penalty, no problem. It takes a couple of days to wire the money to their new solo 401k. They take it out as a loan. They withdraw $10,000 as a loan. What happens with a loan? Well, no federal or state tax to be paid. Now it's a loan. That means they do have to pay themselves 5% interest on the unpaid balance. And it can be interest only. So, a couple times a year they cut themselves a check for 5%. But where is that check going? To whom is it being paid? It's being paid to their solo 401k. So their solo 401k continues to grow. If you go back and look at the other side where we were taking the money out of the SEP or the IRA, we killed it. It's dead. They paid the tax, they'll never get it back, and there's no more left in the IRA. Whereas now with the solo 401k, it's continuing to grow. But look at the bottom line. Look at what's really sweet. Do you see how much is left? Oh, $10,000. They have that money to bring to the settlement. You know what this means? This means that you get your commission. Oh, yes. And they, of course, they get their house, which we like also. Now, this money can be used for any reason whatsoever. If you're my client and you come to me and you want to take the money out to buy a boat or a Harley Davidson or something, then I'll fire you because I won't let you do it. But if you want to take the money out to buy an investment property, oh, isn't that a great idea? Now, all of you realtors, I bet each one of you knows at least one or two really good investment properties that you'd like to buy. Well, you could use your solo 401k for that purpose. Or if you have clients who are thinking about buying a home or a first home, this is where they can get the money. Now, if you take the money out for any reason other than your primary residence, it needs to be paid back within 5 years. Okay. Tax updates. Yes, if you would like us to send you a tax update 4 times per year, 4 times a year we send out a little news email. It's really short, like 1 page long, and it'll tell you not only to make your estimated payments, but we'll tell you if they've updated any of the tax laws or if they've changed anything that will help you or hurt you. As soon as we know a little bit more about this new tax law, I'll be sending out a summary of it, which especially will be geared for realtors, which you're welcome to share with your clients. You can use it for any reason you want. On our website, if you go to our website, we have some really neat forms you can download. I specifically recommend the one that's for realtors tax deductions. And there's also a super form that gives you a checklist on your car. There's another one which I love, which is your office and home. And the fourth one, especially for you folks, is very good. It's an investment property checklist of all the things you can use to deduct when you own a rental property. Okay, we're going to open it up for questions. If you have any questions, I'll stay around for a while to answer them. Is anybody listening to switch it over and put on the question department? Hello, hello.
I am listening. Hold on.
Oh, yes, good. Sorry, I didn't put you to sleep, darling.
Oh, no, you were very, there are quite a few questions. Hold on 1 second.
Thank you, sweetie.
Of course. I was waiting for your keyword. Kareem, there you go. So they should be coming through now.
Thank you, thank you. Happy to help everyone.
All right, one of them, can I move my IRA into a sole 401k when and how?
Okay, that's a really good one. Of course you can. It should have been done 17 years ago when the law changed. All you do is get someone to help you with your 401k, and we'd be happy to recommend the person that we use and love. I've been using him for ever since the law changed, and he's wonderful. He's a certified financial planner. But whatever you do, make sure that it's moved to an actual solo 401k, because a lot of times what happens is people are told that they're moving it to a 401k and it ends up not being that. So you want the real McCoy, and if you're paying over $50, you're paying too much. And I'd be happy to recommend mine because he's the best.
Thank you. Can you deduct medical expenses with an HSA as well?
Yes, you can, but it's nowhere near as good, because when you deduct them on an HSA, they don't save any Medicare tax and they don't save any Social Security tax. So you're losing a deduction of 15% tax. Whereas if you do it my way, by the way, I'm always right. So you just have to do what Linda says. I'm always right. You can ask my ex-husbands. Just do what I tell you. You'll be fine. So you want to do it my way so you can get the larger tax deduction. That's the answer.
I love it. Can you still deduct traveling expenses to the office and properties?
Okay, traveling to the office is only deductible if you are absolutely deducting an office in your home. So if you do not deduct an office in your home, then your first trip of the day and your last trip home are never deductible. This is why every realtor who has any tiny little space in their home and they use it regularly and exclusively for business needs to fill out the office and home deduction. It's absolutely critical because not only, and I'm really glad you brought this up, because not only do you get the deduction for the office and home, but now you can deduct far more car expenses. I'll give you an example. I live in Bethesda, and on Saturdays, sometimes I'm on Sirius XM radio. So I get up on Saturday morning, and I turn on my laptop, and I answer some emails and things, and then I jump in my car, and I drive to Eckington Place Northeast, which is the home of Sirius XM radio. I do the show, and then I drive back home. And of course, when I get home, as I'm pulling into the driveway, I start checking emails and checking my laptop or whatever. And so my trip to Eckington Place Northeast is fully deductible because I have an office in my home. But if I didn't have an office in my home, then that trip would be wasted and not deductible.
Gotcha. Confused. What are the income bracket amounts for the new law for federal? It appears there are two brackets, 24 and 35%, but do not know the income amounts.
Okay, they were on the very first part. I think we can go back here. There's much more than that. There's a whole bunch of them. There they are. 10, 12, 22, 24, 32, 35, 37. If they can see the screen right now, that's where they are.
Thank you.
Yeah, it's huge.
Your offers cover Pennsylvania as well.
Oh my gosh, yes, we do. We love Pennsylvania taxes. They're lots of fun. Pennsylvania is a great state because they don't tax pensions, which I think is really nice. You know, we have clients in 30 countries. Most of them are realtors or doctors, and we have clients in 40 states.
Awesome.
Oh, they tax them on the way in. Yeah.
Does the tax, sorry, does the tax deduction for investment property qualify if the property is out of state?
Absolutely. Yes, you can have a property anywhere. You can have it anywhere in the world. I speak 4 languages, and in our office we speak 10 languages. We have clients all over the world, and some of our clients live in foreign countries and own rental properties there. We have clients here who own rental properties in foreign countries. You can have your property on the moon, and if you're renting it out, we're going to deduct it. I promise you, we won't lose it.
If you have an adult 28-year-old child with medical issues where I pay all his medical expenses, can I deduct the medical expenses? This is last year I paid the medical expenses out of pocket.
Okay, if the child is going to be considered your dependent, now for last year, that was still allowed. This year, dependents you don't get any $4,000 deduction for them. But if the child was considered your dependent, then yes, you can deduct the medical bills. However, the problem is you can only deduct the medical bills that exceed, let me get you on this one, 10% of your income. This is a case where if that child can help you in any way, whether it's stuffing envelopes or helping clean your office or can work on your computers or whatever, you could hire that child as your employee, and now you can deduct all of the child's medical bills as a business expense, which saves you federal, state, Social Security, and Medicare tax. I had this happen with a lady who was supporting her mom, and the mom lives with her. And mom had a lot of problems with diabetes and a whole bunch of other things. So I said, and she was paying, my client was paying at least $1,000 a month for medications and doctors and things. So we hired mom, and we gave her the little $300 a month salary, And you won't believe it. Within a year, mom was so excited about being an employee. She'd get dressed every morning and come down and start working in the office and tidying up and answering phones and sorting things out. Within a year, the mom lost 70 pounds and went off all the medications that we were deducting the $1,000 for. So after a year, the mom cured herself just by hiring her. It was talk about a win-win situation. So perhaps if the child is capable of doing some work, we should hire them as their employee. It would be super if that would be, if possible.
Awesome. Is it true that our realtor fees, MRIS, Century Lock, etc., are no longer deductible?
Absolutely false. Those laws did not change. They're still deductible. And if you go to our website at www.tax-masters.com, you'll see a place where it says Get Prepared, and you can download the form that's for realtor deductions. And it's, yeah, okay, no problem. They're telling me that it's based on last year's law, but that law that we're talking about did not change. Anyway, if you download that, you'll see that it's on there. And yes, please deduct your MRIS dues and your MAR dues. All of those things are very, very important. Those are the dues that helped the real estate lobby keep the tax laws at least where they are now, which isn't as good as they were, but better than they could have been.
Thank you, Linda. One more question, and the rest look like a lot of thank yous. You did a fantastic job looking for the recording, which we will have this recorded and up on our website within 24 hours. We'll also email blast it out to the membership and everyone that was listening today. So you will get Linda's information in her presentation today. But the last question is there a difference in the RMD in a solo 401k?
There is no difference in an RMD for a solo 401k. RMD stands for Required Minimum Distribution, and this is something that's required for someone who's over the age of 71 and a half. They're required to withdraw a certain amount of money from any retirement plan that they have. So that doesn't change. Remember the lady I told you about, she's 84 years old. She puts $50,000 a year into her solo 401k. Well, because she's had a solo 401k with me for a long time, she has over $3 million in her solo 401k because it's grown so much. I know my solo 401k increased by 23.11% last year because my investment advisor is absolutely wonderful. I'm happy to recommend him. But in any case, yeah, she has to take out almost $100,000 each year because she's over 71 and a half. So at least she puts 70 in, she takes out 100, she puts in 50, so she only pays tax on the difference. But yes, the RMD rules do not change, no matter whether you have a qualified plan or an unqualified. But I don't know why anybody would want to have an unqualified plan. Everybody should have a solo 401k. Just do what Linda says. I will never tell you to do something that's bad for you. I will only tell you to do things that are going to be helpful and tax savings.
Linda, thank you so much. You're amazing as always. Everybody loved you, and we can't thank you enough. I will blast it out, as I said, to the email or to the membership, and then we'll also have it on our website. If you have any questions, please feel free to email us here at MarylandRealtors.com, and we'll get them over to Linda and go from there. Have a great day. Thanks, Linda.
Thank you so much. I hope I helped some people who wouldn't have otherwise been able to be helped. I love talking. Just give me a microphone. I'm fine. Thank
Awesome.
you.
Have a great day.
Thank you, honey. Bye-bye.
Bye.